on probably the nicest spring night we've had so far. This is the very first event in our Darien Library Financial Literacy Series, which is sort of a pilot program that I'm trying to see how it goes, and we may have a more extensive financial literacy series in the fall, so I'd love your feedback if you have any. If you did not get a handout tonight, you can leave your address on the table outside on your way out, and Julie will send them to you, so no worries if you didn't get one. In case we haven't met before, by the way, my name is Erin, and I'm the head of adult programming here at the library. I'd like to mention that programs at Darien Library are made possible by our annual Friends of the Library campaign, so thank you for your continued support to make our programs and collections available to the community. Tonight's speaker is a proponent of financial literacy and investor protection. She's written and lectured on various investment topics and writes a weekly investor education column in the Stanford Advocate, Greenwich Time, Danbury News Time, and the Connecticut Post. A personal money manager for over 30 years, she was honored for her previous book, The AARP Retirement Survival Guide, by Booklist. She's here tonight to talk about her most recent publication, Managing Retirement Wealth, which debuted at number 3 on Amazon's list of hot new releases in personal finance. So please join me in welcoming to Darien Library, Miss Julie Jason.
Hello, everybody. I'm happy to see such a grand group here. So, my first trip to Darien Library, and it's a beautiful library. I assume you all come here all the time. Is that right? Lots of yes, yes. Well, I'd like to talk to you about a topic that is of great concern to anyone who's approaching retirement or in retirement, and that is just how do you make it through those years of uncertainty? Lots of things that are uncertain in terms of aging, and there are a lot of things that are uncertain in terms of the markets, as we all know. So how do you pull it all together so that you can have a secure retirement? And that's the topic that I address every day when I'm dealing with my clients who are individuals just like you, with hopes and dreams and some fears as well. So let me talk to you about a few things that I see that can go wrong, and by knowing what those things are, you can address those in your situation so that they don't go wrong for you. And one of the things that I see very often is that when people start investing in their 30s and their 20s, 30s, 40s, and the like, they tend to think in terms of individual investments. They tend to think in terms of a stock, a bond, a mutual fund that they might be buying. And they don't really take a look at the whole entire picture as much as one should when one is approaching retirement or in retirement. So the big difference between investing when you're 20, 30, or 40 and when you're investing for retirement or in retirement is that you have to look at your collection of investments as a whole that is guided by some sort of uniform objective. And you can help me out here. What do you think would be an appropriate objective for this time of life? And some of it's pretty obvious, so help me out here with what are your thoughts? What would be an appropriate investment objective? I'm sorry?
Revenue stream.
A revenue stream. So some kind of stream of income, what I would call an income stream, that gives you what you need to have to cover the gap that you may have between what your expenses are and what you're getting in as income from pension and Social Security. So there probably, with many people, there is a gap between income coming in from pension and Social Security and what you actually need to spend in retirement. So one of the goals is to create income that will fill that gap for today. What's another component? Safety is another component, so risk enters into it. How does one view that as a goal? We'll talk about that in a minute. So we have income generation for today. What about inflation? So you want to offset inflation. So creating income for today and enough to offset inflation. However, inflation will impact you for the rest of your life. What else? Healthcare is a part of the issue. It's part of one of the uncertainties that'll go into what those expenses are. What else might be an objective? Yes?
Making sure you don't outlive the amount of money you have.
All right, making sure you don't outlive your money. And there's another element of it. Sorry?
Die young.
Die young is a great solution. I would recommend bungee jumping or motorcycling. What else? There's one other element. Allocation's a piece of it, but that's not what I'm thinking of. There's one other element. So how much money do you need to have for how long? What about heirs? Do we care about heirs or not? Well, some do and some don't. So you might factor that into the equation. So let's see if we can restate that into an objective that you can use. So we want to create income in sufficient amounts to cover the gap between Social Security pension and what you need to spend. Secondly, we want to make sure that that number increases as purchasing power decreases, so we want to factor in inflation. The third thing we didn't talk about is taxes, the effect of taxes, figure that in. And then has to last a lifetime and possibly also have something available for heirs as well. So if you tie all those things together, you will have a proper objective for a retirement portfolio. Now, because we're putting in the inflation number and we're also putting in a possible legacy, by definition, someone mentioned here, this gentleman here mentioned asset allocation. So by definition, asset allocation will be part of the process that you will need to use to arrive at the correct construction of a portfolio. But you can see if you're stating your objectives in this fashion, you can see that you have to have a big picture view of all of your holdings and all of your accounts. So what tends to happen is when someone comes into our office, what tends to happen is we always tell them to bring in everything that they would like to review. And what people bring in are their various account statements, and they also bring in their wills and their trusts as well, and possibly their tax returns. But the account statements, when you look at someone who is 65 or 60, they'll have a collection, so they may have an account with a major wirehouse, such as Merrill Lynch or UBS. They may have an account with both. They may have an account with Schwab or E-Trade or Fidelity. They may have some mutual funds that they've acquired that they hold at Vanguard. They may have a number of 401ks. They may have IRAs. They may have CDs at banks that are IRAs. They may have some 403bs, depending on where they've worked. And you see, it's a bunch of stuff, typically with no rhyme or reason behind it. And that stuff did a lot of good to get them there. But now, at a pivotal point, at a point at which risk is something that needs to be considered, at a point at which you can't really remake that money that you've made in 40 years of working, now you need a plan. And you need to address how that plan is structured, and the method for doing that is through personal portfolio management, which is the subject of the book. And the reason I wrote the book is because of my many years of practice in this field, and because I am a securities lawyer by background, so I always bring the legal background into everything that I do, which means I read prospectuses. I used to write prospectuses. How many here read prospectuses? A few. Okay, good. Probably lawyers or accountants, right? Who reads the prospectus? Lawyers or accountants? No one else would read a prospectus. So I bring that background to personal, what I call personal portfolio management, and it's a term that's not used in the public vernacular, but it is a term that I think very well describes what is this process that people can benefit from. So the first step of the process we talked about, it's really getting a handle on what your goals are. And it's goals stated in a particular way, goals stated to produce that income, etc. But then how do you go from that collection to that portfolio? Well, going from the collection to the portfolio is making a series of correct decisions, and they are connected. These decisions are connected in such a way that they are intended to produce the result that you're looking for. But it's not a one-step sort of thing that you can do. You can't really create a portfolio in one day and be set. It is a series of correct decisions. So let's talk about that. What are some of the decisions, aside from the overall big picture structure and aside from thinking of things as a portfolio rather than as a collection? What are some of the things that one would need to decide as one goes forward and structures a portfolio? What are some thoughts? Yes?
Well, if your accounts are as distributed as you described, you might think about how you would combine them.
All right. All right, now that's an excellent point. If you have this collection and you have them all over the place, it might be a good idea to think in terms of your favorite custodian, your favorite broker, where you would like to have that collection housed. Maybe 10 places are too many, maybe 2 or 3 might be appropriate, or even in some cases 1. But yes, organization, by the way, just organizing the accounts that you have is a huge step in the right direction. And let me digress a minute at this point, because it's another organizational issue. For those of you who read my column, you'll notice that I talk frequently about taxes, and I talk frequently about estate planning and trusts. And one of the areas, the other area that is we see as a risky area, is when you go to the problem, or the trouble of putting together an estate plan, and you have documents that are written by very good lawyers who do a very good job in creating these documents for you, but you may or may not read them, but worse, you may or may not compare the document to your actual holdings. And if you have multiple accounts in different places, it might be easy not to do this. But one thing that I suggest that you all do, perhaps this weekend, is to make it a job to sit down and collect all those statements and put them into 2 batches. One that is where you are the account holder, and the other where your spouse is the account holder. And just create a list of those 2 types of documents, and include your deed, include life insurance policies, anything that you own. So the deed on your home, include that. And I recommend also making a spreadsheet that would make a list of all the property you own, all the property your spouse owns. And the reason for this is because the financial assets must complement your estate plan. And if they don't, you can have unintended consequences. And this is the topic of my column for this Sunday. It is a fascinating sort of thing that we all can easily do, but many of us don't. And that lack of coordination between the actual ownership of the account and what is in your documents, in your wills, and in your beneficiary designations can lead to unintended consequences. And what we see quite frequently is that because of the planning that's done to avoid estate taxes, you can have a will that has a formula clause in it. Anyone here familiar with formula clauses? Any trust and estates lawyers here? So the formula clause, what it does is it speaks in terms of the federal estate tax exemption. All right, and I see some shaking heads. You're familiar with that. And if you've read your wills, the likelihood is that you have such a clause in it. And what happens is, depending on what the exemption happens to be at the time of death, typically that amount, which is over $5 million right now, for those of you who have assets of over $5 million, that whole entire amount would go into a trust. So many times what we see when we're talking to our clients, what we see is that is unintended that couples don't normally want all their money or most of their money tied up into a trust. And it's a big surprise if that happens. So one thing I do recommend is that you take a look at your documents, actually read them, and take a look, combine it with looking at the exercise that you're doing for your portfolio, and you'll see by reading that document and by looking at your holdings, the question you have to ask is, if I die first, what does my spouse get? If my spouse dies first, what do I get through working through those documents? And it is a huge eye-opener. And I highly recommend that you do that. So now let's go back to the portfolios. So now you've collected these account statements. What you want to do is see, what is the rhyme and reason behind your holdings. And in most cases, people find that it's hard to get a handle on it, and it's hard to see rhyme and reason. Can anyone relate to that? Is anyone agreeing? Okay, I get agreement. So the project then becomes coming up with those objectives and then either dovetailing what you currently own into those objectives, or basically start from scratch and determine how can you meet those objectives. So now let's say we have an objective of creating income of X dollars. So the issue is, how do you do that in a low interest rate environment like this? So let's talk about that a little bit. What are people doing today in a low interest rate environment? Anybody care to share? Yes. All right, so now that buying high quality dividend producing stocks is a very good strategy for creating an income stream. And of course those dividends come in typically quarterly, so you have to plan when those dividends are coming in and how to use them. Anyone else doing anything else right now in terms of income? But that is an example. That's a very good example of how you can create an income stream. So other sources of income are bonds, of course, interest income. There are numerous other sources, and if you go into a bank lobby, for example, and you talk to a bank broker, you might be shown a product that creates income, different kind. There are various kinds of annuities that create income and the like. My only caution to you about that is not to buy a product until you have the whole picture planned and you know how that product will fit into your overall portfolio. It's too easy to buy something that appears to be income producing and then find that it doesn't have a real good fit in the overall plan. So the construction of the portfolio is something that, of course, is key. And once the portfolio is constructed, then comes monitoring. And monitoring is something, how many people do? How many people monitor their accounts right now? And I'll discuss what monitoring means. Okay, so now share with me what you mean by monitoring, and I'll share with you what I mean, and let's see if it's the same. So anyone who raised their hand? Yes?
Rebalancing.
Okay, rebalancing is a method to come back to a specific allocation of stocks and bonds, which, by the way, some people believe in and some people don't believe in that technique. So it is a technique. So you would monitor how much you have in stocks, how much you have in bonds, and then rebalance. What other things do you watch, and how frequently do you watch them, and what tools do you use? Yes, sir.
You know, your Yahoo and some of these other sources have places where you can put your stocks in, and prices come up daily, and put in numbers here. Sit there every day and see what your total value of your investments in stock market or bonds. By the way,
there are a lot of very good resources on the internet, and Yahoo happens to be one of them. There are many others. The American Association of Individual Investors. Is anyone? Okay, so we know some people who are members. What is the membership for the AII? $25, something like that? Something like $25. Wonderful resources, and I highly recommend them to you. if you happen to purchase the book tonight, there's a little code in here that gets you free membership to the AII, as well as some other memberships as well. So it'll pay for the book, more than pay for the book. But there are many resources available that can help you monitor. One of the things that, once you have a portfolio, one of the things you want to watch for is the income that you need being produced, and that's something that you can address. Secondly, when we structure portfolios, we're looking at risk and reward together as a unit. And I want to point out something to you as a tool. For those of you who have a handout, I know many of you did not receive a handout, and we will email this to you if you'd like. We just need your email address out in front if you did not receive one. But this is a sample only. It's not intended to mean anything other than to show you one of the things that you'd want to look at. So this graph takes a point of view of what the returns were on the portfolio, and the portfolio is blue, and it happens to be on top, but it could be on the bottom. The red is S&P, the S&P. So the position of the graph really doesn't mean anything. What it means, though, is it's a metric to follow. At least one metric, one benchmark is following, comparing to the S&P 500. Now this is just returns, but it is something that needs to be done because it gives you a sense of how you're doing compared to the S&P 500. It doesn't mean you may not be 100% invested in stocks. It's still a metric. Now, it means nothing unless you look at risk. So the back of this page contains a couple risk measures. So the performance always has to be taken into account in terms of risk, because you don't know if you're doing well or not unless you factor in risk. So on the back here is one example of how you measure risk. And if you look at the numbers and look at the bottom of the table here, you'll see standard deviation, and underneath there you'll see beta. So the beta of the portfolio is 0.5. Now who knows what that means? And I'm sure many of you do. But you don't want to speak up. So the beta, if you have a beta of 0.5, that means that it's half as risky as the market. A beta of 1 indicates the risk of the market. And now I'm talking about the stock market. So when you put those two things together, the return with the beta or standard deviation, look at standard deviation for a minute. The portfolio standard deviation is an 8.4. That is meaningless unless you can see what the standard deviation of the S&P 500 is, if that's your benchmark. And here you can see it's 15.8, and that's about half right there. So that gives you an easy measure. If you don't have those two numbers, you do not know how to measure your success or failure. So this is an example of, again, taking a portfolio approach, what one needs to look at. Now, let me ask you something. From the point of view of a retirement portfolio, do you think it should have a high standard deviation or a low standard deviation, or neither? What are your thoughts?
Depends on your age, right?
Well, let's say it's a retirement portfolio and you're already retired. So let's say you're 65. What are your thoughts? So keeping again, I'm sorry?
Depends on your risk appetite.
It depends on your risk appetite, absolutely. So if you have that gap that we were talking about before filled with a pension, so that you really have no gap to fill from your portfolio, your risk appetite can be higher. You can afford to take on more risk. But let's say you need that income and you don't want your portfolio to dive as much as the market does. What about that circumstance? So you can control, I'm sorry?
Low.
All right, so you want a lower number. Not everyone would. You know, there's a debate as to what number you would want, but you can control your risk by controlling standard deviation and beta. And for a retirement portfolio, it is essential to know those numbers so that you can control it. Well, let me ask you a question. So how does one structure a portfolio for a lower beta? And let's just stick with stocks. So let's say you have 2 stocks and you want a lower beta portfolio. How can you, is this a number you can find? Yes?
You could avoid the whole thing, simply putting stop loss.
Stop losses are not the answer here, but it is a way to lower. You just sell out if you have something in your portfolio that you want to sell at a certain point. And thank you for bringing that up. But most people here will not be doing stop losses. So yes, sir.
You can invest in companies that have high bond rating, that have a track record of quarter-over-quarter increase in earnings, good return to shareholders. And somebody mentioned a while ago, throw off a good yield. All that, be it General Electric or something like that, would be a pretty solid performer.
Right. So there are metrics that you can look at, and those would be good metrics. However, some of them could also define a high beta stock. You can actually look up the beta of a stock. And there are many different sources. You're all familiar with Morningstar, I'm sure. Morningstar is one source where you can look up the stock beta. Standard & Poor's publishes a beta. So you can actually construct your own portfolio if you're a do-it-yourself investor by doing some research and looking for low beta stocks. You can do that. Let me also mention another, since we're talking about higher quality, high dividend paying stocks. You never want to go without too high of a dividend, but a good list to start with to look at is Standard & Poor's Dividend Aristocrats list. You all familiar with that? Anyone familiar with that? It's a good starting point. Standard & Poor's publishes a list called the Dividend Aristocrats list, and what it is, it's companies that have raised their dividends for 25 years or more. And that's just a good place to start. You can't just pick off that list any names that you're familiar. You have to go further, but it's a wonderful place to start for this type of market. So just wanted to share with you those 2 metrics to show you what it is that you should look for. Now, monitoring, when I'm talking about monitoring, and yes, I'll come back to your question in 2 seconds. When I'm talking about monitoring, my sense of monitoring is going to be slightly different than yours, because unless you're doing it full time and you have, so I'm dealing with software programs that give me this information on a daily basis, and I have reports coming to me throughout the day. You may not have that. And so one of the other things that I want to share with you that we look at, aside from these 2 metrics, is we do look at individual holdings and how they're doing compared to the sector. And you may do the same thing if you're using stop losses, or you may just use an absolute stop loss. So one of the things that works that I'd like to share is, in different times, markets, of course, respond to events or to negative events, positive events, but let's stick to negative events, because when you have a retirement portfolio that you're in charge of, you have to think defense rather than offense. And if you think defense, what you will be doing is getting rid of the problems earlier than other people or than other times of life. And one way to do that is by looking at the individual holding, and now, once you own it, now you want to watch the price of the holding. What is the pattern of the price action? So what you want to watch is how's that stock doing compared to its sector, and also compared to the market. So you're looking at basically a graph that's comparing the stock to the sector that it belongs in and to the market as a whole. And if you have three charts where you're comparing yourself to the sector and to the market as a whole, you can stop problems before they become big problems. And I'll give you a good example. So Lehman Brothers, as the financial crisis was developing, was falling faster than its sector. So that was an indication that there was more selling going on than was going on in the sector. That's a red flag. So some investors would want to get out at that time. Of course, other investors might see that as a buying opportunity. And we did have an individual who did see that as a buying opportunity, who was a client of ours. And of course, the other thing that you never want to do if you're a retirement investor is to have a crystal ball that you believe in and will use. So this individual believed that the market, that Lehman will be saved because the government will step in and save the day. And this is where we had to part company, because when you're running a retirement portfolio, you really shouldn't use that crystal ball. You should throw it away, simply because they don't work, number one. And number two, if you were 30 and you bet on something happening in the future, that's one thing. But when you're betting with your retirement money, it's just not a good idea. So it's best to go back to what you can measure, what you can control, and what you know. And all of that comes through watching and paying attention. All right, now, under what circumstances should you do this on your own versus going to a professional? So right now, many of you, I'm sure, are working with professionals, and many of you maybe, well, who does their own investing on their own? Okay, so quite a few. So one of the things that is a good idea if you're working on your own is to step back and take that overall big picture view, and then create through online resources such as yours, through AAII, etc. There are many good resources that will allow you to take this view and actually monitor your progress. One thing that I would not do, however, is move in and out of the market based on a hunch or based on anything that's not happening that you think will be happening, or based on an investment that you may buy because it has 5 stars or because it's a hot new fund to buy. If you study what people do when they buy, you'll find studies in here where I refer to people left to their own devices will buy at the wrong time and sell at the wrong time. And there are a number of studies that I refer to here. And the studies they're basically mutual funds are patterns of buying and selling of mutual funds result in studies of when people enter and exit the market, and they just do it at the wrong time. So you have to have a plan as to when you're going to be buying and when you'll be selling. And one of the things that we talked about that'll help protect your portfolio is to sell if you see a divergence between your stock and the sector. That will help you quite a bit. All right, and then those of you who are working with someone, you have to think in terms of what that person is doing for you and what kind of advisor he or she is. SEC studies have shown that the average person, all of us here, we're not familiar with the differences between advisors, and there are differences between the types of advisors that you can work with. And one of the major differences is whether or not they have to tell you about any hidden conflicts of interest or any hidden fees or any reason why they should be recommending something to you that is not in your interest. And so there is a body, there are more financial advisors who are held under that standard, and then there are another set of financial advisors who are held to the standard of disclosure. And I have in the handout an example of the type of disclosure that you need to look for. And this is under the current law. This is just, what I have for you here is the contents. For those of you who have the handout, look for the page that has contents. It's toward the back. And the contents of this disclosure document must follow the prescribed contents, the prescribed order. And I'm just going to run through this very quickly and point out the sections that you need to read. Now, who needs to give you this? So it is the registered investment advisor, and maybe a few of you work with registered investment advisors today. But many of you probably work with the major brokerage firms such as UBS or Merrill Lynch. They are also required to provide you this disclosure document. It's a new requirement, new for 2011. This new requirement went into effect in March of 2011, And it has two parts. I'll take you through the two parts very quickly so you know what to look for. So cover page, all these items have to be in this order. Material changes, that's changes from the prior year. Table of contents. Advisory business, so this is a description of the business of the firm. Item 5, fees and compensation. This is where you'll find conflicts. Conflicts must be disclosed under this section. You will want to read this section if you read no others, but it would be helpful to read the others as well. You want to study this section. Performance-based fees, yes or no, some charge, some don't. Types of clients. The reason why you want to look at types of clients is you want to recognize yourself in this description. Many firms have an ideal target mix, and if you don't fit that ideal target mix, you probably should not be there. And I'll tell you a story about that in a minute. Methods of analysis, investment strategies, and risk of loss. This is another section you'll want to carefully read. Item 9, look at item 9. Disciplinary information. Before this law was passed, it's not a law, it was a regulation, a requirement. The SEC put out this requirement, disclosure requirement. Before this was enacted, it was up to you to find disciplinary information. Now it's here, it's printed, given to you, so it's extremely important for you to take a look at it. Item 10, other financial industry activities and affiliations. This is where you'll find business practices that are outside the business practice, the advisory practice. Item 11 is another area that is essential for you to read because this will go through other types of conflicts. So participation or interest in client transactions and personal trading. Firms are allowed to do trading for themselves or do execute principal transactions, which means they may be buying at the same time you're buying, but they must disclose how they're dealing with that conflict if they're required to provide you with this document. So these are going to be the duly registered firms such as the Merrill Lynch's and the UBS's and the registered investment advisors that must give you this information. Let me stop there for just a second. If you're working with a firm that is not required to provide you this information, do you think it's worth getting the information? Yes, it is. And now you have a format. You have a format that you can go to anyone and ask for this information. Brokerage practices is another conflict area that you need to study. Now, review of accounts. That has to do with monitoring. So, again, very important to read. Item 14. Tell me about item 14. Is that an important area or not? And why? Why do you think so? So this would be the financial advisor someone referring to the financial advisor.
Maybe they get a kickback?
All right, someone here said maybe they get a commission or a kickback.
Your lawyer recommends that you see your financial advisor.
Yes, say your lawyer recommends you see your financial advisor.
It gives you the phone number.
Okay, so now this section will cover that. Is it important? Why? Potential conflict, right? Everyone agree? Let me tell you a little story that illustrates what a conflict is. So many people will say, what's the difference? Because it's disclosed, so you'll know and you can judge. But in one of these meetings a few years ago, a woman who had just lost her husband came up to me and asked me to meet with her, which I did. And by the way, because I write the column, I set aside 2 hours every week to meet with readers. So if you read the column, feel free to call. And you can call Kelly here. Kelly, say hello. And where's Alana? Alana back there. So feel free to call. Every week we set aside 2 weeks to meet with readers. So, and I always tell people, just bring anything that you'd like me to take a look at. So she came in with two bags of unopened mail. And as we were going through the mail together, one of the letters was a disclosure document that said that so-and-so, who was the accountant, was being paid $30,000 a year by this wealth management group that had her account. Now that's interesting. She was not aware of that, but it was disclosed. Any problems there? So you might see a problem coming, right? So the next thing that we found in the bag was a new account form. Now, how many people are familiar with new account forms? Okay, everyone that has a brokerage account should be familiar with a new account form. By the way, if you have not looked at your new account form and you have a brokerage account, an account at Merrill Lynch or an account at UBS or an account at Fidelity or Schwab, take a look at it. So I'm opening it up and I see that she's put down that she's an aggressive investor and that she has 15 years of experience with investing. But she just told me that she had never made an investment decision, never written a check, never looked at a brokerage statement, because her husband was a CPA and a CFO of a major corporation. He did everything. So I knew that that information was incorrect. And I asked her, well, why did you put this down? And she pulled the paper away from me and she said, wait a minute, let me look. And she's looking at it and she sees it is her signature. So she says, yes, I signed this paper, but I remember what happened now. The two gentlemen came to my house. This was right after Mike died. And I just couldn't deal with it, everything. And they told me they'll take care of everything. So I signed the paperwork. So look at what happened. Why is that important? Why is the fact that it was aggressive and 15 years of experience important to the two wealth managers who wrote that in there?
Because they couldn't describe her account.
Wait. Because, tell me again, what, yes?
It doesn't describe her,
It doesn't describe her, so why did they do this?
because they're trying to, they're trying to control the account for themselves.
All right, so you can see there's a problem here, right? Because that should not have happened. But let me tell you a couple of things. When someone loses a spouse, they are vulnerable. They're not thinking. It's the worst possible time to make decisions like this, especially if you have never made a financial decision. And for all of those husbands out there who make the financial decisions for the family, if you say to your wife, everything's in the drawer next to the bed, anything happens to me, just go through that drawer, that's not enough. And I'll come back to this point in a second. But what happened was there was a problem in the account, of course. Why? Because her account was being aggressively managed. She started losing money, and there was a lawsuit. The lawsuit required the accountant to testify on her behalf that she had no experience. What happened? What do you think happened? Any ideas? Yeah.
They brought out that piece of paper that said she was an aggressive investor. And
So that
admitted it as evidence.
That could have been the result, but it was even worse than that. The accountant refused to testify because he had a conflict of interest. Now, how do you like that? He had a conflict because of the money that he was paid, and she wasn't the only client that he sent over to this wealth management group. So his devotion was to the wealth management group. So when people ask me, is it all right if there's a referral arrangement, if a lawyer gets paid? By the way, can lawyers get paid by wealth management groups? Absolutely. Accountants can get paid by wealth management groups. You have to find out, if you are being referred, what the referral arrangement is. But now you have a document that you can turn to. I don't like anything that raises conflicts. I like to have a conflict-free arrangement. And I'm sorry, you have a question. So you're in a position to judge those conflicts, and especially now that you have a disclosure document. I would highly recommend that you do judge them, especially moving into retirement, because there are many points in retirement where people become vulnerable, and you just don't want to be in a vulnerable position, in a transition position, and not have the information that you need, and not have the ability to decide that you need. And during those times, you do not want to be in a conflict situation. And I can tell you that many times we work with couples where there's a disinterested party, and that's not unusual because families do set up, one person takes over some activities, another person takes over some activities, and there is a delegation of responsibilities. But the problem is, you can see where I'm going. The problem is if the leader, the financial decision maker, is the one who gets sick or predeceases the other person, you can see the risk that the other person is at. And it's unavoidable, I'm sorry, it is avoidable. It is avoidable. And the way to avoid it is to think of retirement as a joint venture between spouses. It's not, it's very different in retirement. And if you want to have this dialogue, what I recommend is that you get together on a weekend and make a date, not over a meal. You can't do this over a meal, and you can guess why. And the dialogue should not be about the brokerage statements. It should not be about the finances. It should not be about anything that is stressful. The dialogue should be about something that is family-oriented. So, for example, if you have grandchildren, it should be about, what do you think about, what are your thoughts about gifting to grandchildren? Do you want to gift to the grandchildren? And that's how you start that financial discussion. Always tied to some family event, and you will get a dialogue, believe me. The other thing you need to do is to make sure that your spouse sees you interacting with your financial advisor, sees you interacting with your attorney, sees you interacting with your accountant. Because that's another area where the spouse who's not involved believes that that person is a fiduciary, and it may or may not be the case. I have a woman who came to me just recently whose husband passed away, and she did not realize that the lawyer was working for her. She's the executor. She did not realize that she was in control of the relationship. And in this particular case, the lawyer did not give her information that she needed to make some financial decisions. It was a trust. She didn't know how much money would go into the trust. It looked like the entire estate would go into the trust. There were issues that needed to be decided. But the lawyer decided for some reason that she wasn't going to understand the answer. So as a result, she was helpless. She was dependent on him. And that's not right. That's not right. Every person needs to be dependent on him or herself at vulnerable times. At vulnerable times in particular, it's not a good idea. So I recommend highly that you think about involving your spouses. And that one other point that I wanted to make is that in situations where this might be an issue, what we do is we actually sit down with a spouse who does not have the interest and work with him or her, and it can be a guy, to make sure that they understand what questions to ask, how to get the answers, and how to say no. And that's a very important thing, to learn how to say no. All right, item 15, custody. Why is custody important? Madoff had custody. He had a broker-dealer that had custody, and he had a registered investment advisor as well. If you control custody, you can create a Ponzi scheme. If you don't control custody, you cannot. But of course, large organizations like the UBS's, for example, they will have custody as well. The likelihood of a Ponzi scheme in a large organization like that, I would say, is minimal. Next, investment discretion, voting securities, financial information are all important, but not really the critical aspects. Now the next page, and I'll end on this and then we'll open up for questions. This is a very interesting document that is not normally together with ADV Part 2A. It's Part 2B. And this came into existence September 30th of last year. So it's a relatively new requirement. Your broker needs to give you this document, and it's about him. And it also includes disciplinary information. Before you could get disciplinary information by looking it up, now it's there, it's printed for you. Other business activities, additional compensation is another area where there are conflicts of interest, potentially conflicts of interest, so that's another area to look at. All right, on that was my most important, that was what I wanted to get across to you, and those are the most important points. Yes?
What these are new documents, you already have existing accounts, do they have to send you these?
Yes, they do. Yes, they do. Anyone who is an existing, these documents had to be sent out by March 31st of last year for the firm, that's Part A, and by September 30th of last year for the individual. Now, I can tell you this, that the firms that I've spoken to, most of the documents are included in a stack that's quite long. And it could be buried in a stack that you've received. So I highly recommend looking for it. And I also, the stack that you would be looking for, you know, I would call the firm and ask, where is this disclosure? I'd like to see a copy of it. But this,
Chapters covered in your book?
I'm sorry.
Are all these chapters covered in your book?
No, they're not. But if you would like to see an example of the disclosure, Kelly, did we bring any samples? We can give you, we just brought a couple samples of the disclosure so you can see it. One firm, well, let me step back. The industry, the whole entire industry, estimated that it would cost the industry, meaning the brokerage industry, $100 million to produce just this Part B document. And now I'm talking about the duly registered firms, the Merrill Lynch's, the UBS's, and the like. So collecting all those firms cost them $100 million to produce this document just covering the broker. So it's a major undertaking on the part of the brokerage firms. It's, like I said, a new regulatory requirement. But let me also mention that at the time this was proposed, the public was asked to comment to the SEC on what they saw in these proposals. And I was one of the people who commented and said, no one's going to read this, sadly, because it's so complex. And with the major firms, it's more complex than the smaller firms because they have many lines of business. And those lines of business create conflicts that need to be disclosed. So some of the documents are 75 pages long or longer, and they go into the depths of what those conflicts are. And firms that don't have as many conflicts have smaller documents. Some firms are set up in such a way that they don't have multiple lines of interest, so they have fewer conflicts. So that document can be a 75-pager, and one firm I saw wrote a 40-page document to describe the 75-page document. And in that 40-page document, it said, you, the client, must ask our financial advisor what hat he's wearing. Is he wearing a broker hat when he's talking to you? Because that's one set of regulations. Or is he wearing the advisor hat when he's talking to you? And that's another set of regulations and another legal standard of responsibility. So you see, it's complicated enough for us, but you really have to make sure that, now I'm going back to the spouse, that if you have a spouse that's not that interested, it can be extremely complicated for him or her as well. So thank you for the opportunity to speak with you. Do read my column. Do take me up on calling me if you have any questions that can be answered in the column. Take me up on the 2-hour once a week offer as well. And I will be here for questions. I think many of you need to leave. It's 8 o'clock, but I will be here for questions if you'd like to ask them. So thank you again. Should we take a couple questions from the audience now, or?
You have time.
All right, why don't we take a couple questions? Yes, you have a question back there.
Do you group Fidelity in with UBS and Merrill Lynch? And would Fidelity have to, all of the people that work for Fidelity have to put forth these, disciplinary things? I mean,
Okay, excellent question. Excellent question. So there is a part of a firm like Fidelity that is required to provide this disclosure. And it's the part of the firm that offers managed accounts.
Okay.
And which individual has to give you the disclosure? It's the individual who actually is face-to-face with you or puts together the portfolio for you, who's behind the scenes. Thank you for that question. Yes?
But then would that be different than if you were calling up and making your own decision to buy?
Yes.
Suppose, even though you would ask them whether or not they have a recommendation on a specific security or stock or bond or
Yes.
S&P 500?
Yes, okay, this is very excellent question again. So the distinction is that in your case, you're describing someone who's acting as a broker, strictly as a broker, not as a financial advisor who's regulated under these laws. So the big difference between the broker is held to a suitability standard, not a fiduciary standard, which means that at the point of sale, his recommendation must be suitable for you, meaning it has to meet your financial needs basically and your makeup. If you were talking to a fiduciary, now he has to give you that disclosure because now conflicts come into play. You can have conflicts. The law says there's no problem with conflicts in a broker relationship. So, there's a dividing line there.
I know it's simplistic, but how are you defining conflict? When you say it's okay for conflict.
All right, well, let's say, I'll give you a really good example. Let's say you buy a mutual fund from,
I haven't bought it.
I'm sorry?
I haven't bought it. It's been recommended that I buy it.
I'm sorry, a mutual fund?
I didn't venture to buy a mutual fund.
Okay, but you have purchased mutual funds based on a recommendation? Okay, fine. Great example. So you go to a broker and the broker says, I recommend that you buy this mutual fund here. All right. Where's the potential conflict? Let's say this mutual fund here pays the broker 3 times more than this mutual fund over here. He doesn't need to tell you that. He gives you a prospectus, but he's not required to give you this mutual fund over here that pays him 1/3 of what this mutual fund pays him. So you have to ask, in a suitability arrangement, which is under a suitability standard, it's basically buyer beware. Same standard that applies commercially to all other relationships. If you're building an addition to your house, it's a buyer beware standard. If you go,
are acting on behalf of themselves, although it may not appear that way.
well, that's well put. And again, there's nothing wrong with this arrangement. What can go wrong is if you don't know about this arrangement. So a broker who is held to a suitability standard can't make a recommendation to you that is against your profile. So the typical example would be, the 98-year-old widow who's sold, all her money goes into Apple stock, for example. That might not be suitable for her. But let's say it were a mutual fund that was suitable for her, meaning a low-risk mutual fund, let's say, but the fee to him is higher than another mutual fund that he could sell with a lower fee. No problem there. A fiduciary, on the other hand, would have to tell you that he's selling you a fund with a higher fee than you could get elsewhere, and it would be against, he'd have to deal with that conflict of interest. So it has to do with serving the client or serving yourself, but it's a very fine line, it's a gray line, and there's something, the SEC is considering making the law uniform so that all financial advisors will be held to the fiduciary standard, but they are not all now. No. Yes?
Some well-known mutual funds apply a load, and that load becomes a commission for the financial advisor. And
Can everybody hear?
Fairly well known.
So some mutual funds are sold with a load or a commission that goes to the broker, which is And that's disclosed in the prospectus.
Right.
So it's not something that's hidden from you if you search.
That's right. So you've got a choice to buy that, to deal with that type of advisor, or one that works on a straight fee basis.
That's right. Those are basically the two types.
Those are the
Yeah.
two types. And it seems like it would be probably a more favorable deal for the investor to work with one who works on a fee.
Okay, so maybe, maybe not. You know, maybe it's better for someone to work with an advisor who is paid based on an advisory fee, which, by the way, would be disclosed in that document. Or he could also be paid by commission as well, or just the advisory fee. Or you could go to someone who's just paid by commission. If you go to somebody sitting in a bank lobby, how are they paid? And they sell investments. Okay, we've got some people saying salary, some people saying commission. So now if you go into a bank lobby and you want to buy an investment, you better ask. I can tell you the answer. The answer is commission. The bank lobby brokers are brokers paid on commission, and there might be some exceptions in certain banks, but you have to ask the question so that you know. Again, not that one is better than another necessarily, because in certain circumstances a fee's better, in certain circumstances a commission's better. It depends on your approach, depends on what you need, depends on what you're looking for. So let's say you are a savvy investor. You've been investing for your entire life. You do your research. You use Yahoo Finance, and you're a member of the AAII. You will be able to judge whether or not you want to pay that commission. But probably in that case, you'd probably want to go to E-Trade or Schwab, because you don't need to go that route. But let's say you're a couple, and one spouse is not interested in investing, and you want to make sure that that person's taken care of should something happen. Now, do you want to put that person into that environment of that commission-based environment if they don't know how to deal with that? And the answer is absolutely not. There might be a good example, as that gentleman raised over there, good example of going to someone who is not paid based on what you buy, but paid based on what you do. So in other words, how your portfolio is structured. So, good example. Yes?
Could you explain briefly what the difference and emphasis between this newest book and the previous one, the
Oh, here's a fan. They're very different. So the question is, this, for those of you who got the handout, the two books. These are my last two. The Managing Retirement Wealth book is the sequel to the AARP book. So the AARP book, which I'm very pleased got a number of awards, including Booklist, which is the American Library Association, and top 10, one of the top 10 books, Booklist. Managing Retirement Wealth also just received its first award, and that's the Eiffel Award. But the two books are very different. The AARP book takes you through cash management. How do you know how much money you need to live on? It takes you through the calculations, lots of tools, lots of checklists, etc. The second part of the book deals with what you will be shown if you're going to a financial advisor. What kinds of products are available to solve that dilemma of creating income? And that section, by the way, of the book is really important for people who are thinking about buying an annuity or a variable annuity or some of the CD alternatives, because it gives you a way to compare and contrast them, and also gives you questions to ask the financial advisor who's selling you the product. Some of those products are extremely complicated. One of the products that are reviewed for the book, if you counted all the pieces of the prospectus, they were in the hundreds of pages. And I actually had to sit down and do a diagram. And keep in mind that I used to write prospectuses. I had to do a diagram to see how the guarantee works. These are guaranteed products. And anytime you have a guaranteed product, you need to know under what circumstances the guarantee works. This is kind of interesting that when I was working with the AARP to do this manuscript, the gentleman I was working with, I had a sentence in there about when the guarantee doesn't work. And he called me up and he said, well, what do you mean it doesn't work? Yeah, it's a guarantee, it's a guarantee, it's a guarantee. And I explained to him that in financial services, there's no such thing as a guarantee that is a guarantee that is a guarantee. There are always conditions. And as you could imagine, I mean, look, just pretend you were setting up this product that would pay lifelong income and increase payments over time, which is what this product was all about that I was describing in the book. If you had such a product, if you were creating such a product, and you had all these baby movers out there who are going to give you lots of money, who are going to live 30 or 40 years after they bought the product, after they were getting income, how would you structure that? Where would you invest to deliver on that promise? You know, we all have the same investments available to us, whether it's a company offering a product or it's an individual investing in a product. So, very difficult to deliver on those types of guarantees, especially if you don't know, the company doesn't know how long, first of all, how much money they will raise and how long people will live. So those guarantees are extremely important to understand. Now, did I answer that question? Because I think I might have gotten off track. Did I? Sort of. Okay, let's come back. So what was, you forgot the question, good, okay. Oh, I'm sorry. The difference between the two books. Yes, I'm here. Okay, so the AARP book is the starting point for someone who wants to really figure out where they're at. And also, there's a section in there about scams and how to avoid scams, how to recognize scams, and that is a great section because what the AARP did in connection with FINRA is they put in undercover investigators into situations in which retirees would be approached. And they came up with common methods to influence people to do something that may be against their interest. And once you read those tactics, you will never be influenced by them. And so I go through all those tactics. Now, one of them is to treat you in a certain way that makes you think that you're the mother or the father. So it's the financial advisor puts himself into a position where he's asking you for advice or asking, who should I be dating, that sort of thing. And, so there are methods that are used to instill confidence in you and get you to act in a certain way that may not be in your interest. So it's a fascinating, that's probably my favorite chapter. It's a fascinating chapter. The second book, this one, is all about how to structure a portfolio. So this is a process, and it helps in your thinking and your decision making. So it's very, very different. The other book has a lot of information in it. This does too. It has a lot of stock information in it, market information, how to watch the portfolio, how to make those critical decisions so that you don't run out of money. And thank you for that question.
We have time for one more.
Okay, one last question. Yes, sir.
With the explosion of M3 money supply, are you forecasting an increase in the inflation compared with a few years ago? And what's your forecast for inflation 10 years from today?
So now, I think people here know that there are two things that you cannot do, and that's forecast inflation or forecast interest rates. It's like that. It goes back to the crystal ball. It's the most difficult thing that an economist is called on to do. What's your thinking?
Well, you look at the M3 and it's just exploding, so we're basically, we have a problem.
So
the value of the money is just going to go to zero, or it's going to go to nothing.
Thank you. That's a great answer. If we pay off the debt, we don't have a problem.
The cost of a gallon of gasoline is about the same in gold as it was in 1940.
Right. So on that note, where we're looking into the future and we don't know how to forecast, and none of us does, we will, I think, terminate on that point. And thank you very much for that final question. Thank you. Thank you.